Indexed Universal Life. Life insurance with cash value. WFG World Financial Group. Life insurance gives you peace of mind as you plan your family's future. Indexed Universal Life. Protecting your family's future with life insurance is a cornerstone to a sound financial strategy. However, determining what type of life insurance is right for you isn't always easy. Should you select term insurance, or should you choose a policy that has the opportunity to grow some cash value but may present some risks? Indexed Universal Life (IUL) insurance is one option that includes a cash value component and has grown in popularity, in part, because it has a reduced risk of loss in a down market. Let's take a closer look at IUL insurance to help determine if it's an option for you as you develop your financial strategy. What is an IUL policy? Among the top selling points of an IUL policy is its tax-free death benefit, tax-deferred growth, tax-advantaged loans, guaranteed minimum interest rate on the cash value of the policy. However, IULs do cap growth. For example, if the IUL policy has a cap of 8% but the indexed earnings, excluding dividends, is 10%, only the cap limit of 8% will be earned in the IUL policy's cash value. Additionally, the fee structure can seem high when the cash value of the policy is low. IUL policies do not invest directly in equities or bonds, but offer a choice of fixed accounts and indexed accounts based on the S&P 500, the Dow Jones Industrial Average, Euro Stoxx, Hang Seng, or one of several other indexes. A guaranteed floor. Index changes can be positive or negative. With an IUL you have the security of knowing you will never be credited less than the policy's guaranteed minimum interest rate, or floor. This protective measure ensures that your IUL policy's account will always credit a minimum amount of interest. It's important to remember that avoiding loss can be as crucial to your strategy as realizing gains. IULs offer limited upside market potential with downside protection. Any increase in the policy's cash value is locked in so gains aren't lost should the market fall. Fee structure. The IUL fee structure is based on the amount of the policy's death benefit, not its cash value, which means that, in most cases, if the death benefit of the policy is low, the fees are low. IUL's fees can include monthly cost of insurance, policy and rider charges, administrative charges. If the death benefit remains the same, then the fees will be constant. This means that, with a well-structured IUL policy, as your cash value grows your fees become a smaller percentage of your policy's total value. Avoiding loss can be as crucial to your strategy as realizing gains. IUL and taxes. So what are the tax advantages and consequences of an IUL? Earnings grow tax-deferred, and taxes on an overall gain are due at policy surrender or lapse. The guaranteed death benefit passes to the beneficiary income tax-free. The policyholder can take out a tax-advantaged loan, if necessary. However, the policy death benefit and cash value are reduced by the amount of any outstanding loan and certain fees may apply. Cash withdrawals, or distributions, are also available but are subject to limitations. Transfers can be made tax-free. Your funds can be moved from your indexed account in the fixed account several times per year depending on the policy's restrictions. The policy's premiums are not tax-deductible. You can access your money in the policy without an IRS early withdrawal penalty, regardless of your age. IUL features. When determining whether an IUL is right for you, consider the following features and benefits. A death benefit that is free from federal income taxes. An interest percentage cap, determined by the provider, that is the maximum percentage that can be earned on the cash value portion of the policy. The potential for competitive tax-deferred cash value accumulation to use later in life. Living benefits that give you the ability to take policy loans and withdrawals. Policy riders that customize the policy to help meet long-term objectives while providing flexibility to meet current goals. Security of the company guarantee and minimum interest rates. IUL policies are not an investment in the stock market and do not participate in any stock or equity investment. Costs, which can be higher than fixed insurance costs, can include mortality and expense risk charges, cost of insurance, and a surrender charge for termination of the policy prior to the surrender charge period. Additional charges may be incurred if a rider or additional features are added to the policy. Gains from the index may be credited to the policy based on a percentage rate, referred to as the participation rate, which is set by the insurance company and can be anywhere from 25% to more than 100%. Your life licensed WFG associate can help determine if an IUL policy is a good fit for you. What's next? Your life licensed WFG associate 4 can provide you more information on the features, benefits, and other considerations that will help determine if an IUL policy is suitable for your needs and a good fit for your financial strategy. If you are considering an IUL, make sure you thoroughly understand its tax-deferred growth, payment, fees, and expense structure. Your life licensed WFG associate can answer any questions you may have about the policy you are considering, as well as provide you with information on other types of life insurance that also may be right for you. As with any life insurance product, you must carefully consider your personal situation and financial objectives to choose the type of product that best meets your needs.
Now that you've heard from the experts, you may be starting to realize that your 401k or qualified plan is not all that it was cracked up to be. Do you know that there's an IRS-approved tax-free 401k alternative that locks in the gains that you earn each year, and at the same time, it guarantees that you'll never lose any of those gains when the market crashes again? To help you understand why the tax-free plan is so superior, I'm going to show you how the two plans compare over a person's lifetime. But before I go any further, let me show you the basic information that we're going to use in this comparison. We have a person that's age 35. They're going to save money until age 65. They're going to start taking income at age 66. Their current tax rate is 25%. We're going to show the future retirement tax rate at 25%. And for now, we're going to leave